Let me tell you something that might change the way you think about investing forever. Every quarter, millions of investors make the same catastrophic mistake. They obsess over earnings reports like they are fortune tellers, reading tea leaves. They stay up late watching after hours trading. They refresh their brokerage accounts every 30 seconds, waiting to see if their stocks went up or down. And most of them, the vast majority of them, would have been better off doing absolutely nothing. I've been through more earnings seasons than I can count. I bought my first stock in 1942, right in the middle of World War II. Since then, I have watched thousands of companies report quarterly results. I have seen stocks surge 50% on good earnings. I have seen stocks collapse on numbers that missed expectations by a penny. And after all these decades, I have learned something that most Wall Street professionals still do not understand. Quarterly earnings tell you almost nothing about whether a stock is a good long-term investment. Now, that might sound strange coming from someone who reads financial statements obsessively. I have probably read more annual reports than anyone alive. I spend 5 or 6 hours a day reading. But there's a huge difference between understanding a business deeply and trying to predict what will happen in any given quarter. The investors who build real wealth do not try to trade around earnings. They find exceptional businesses with durable competitive advantages, and they hold them for years, often decades. They understand that quarterly fluctuations are just noise in a much longer signal, and they position themselves so that no single earnings report can meaningfully impact their financial future. Today, I am going to share with you the only 3 stocks I would buy before the next earnings season. But I want to be very clear about something. I am not sharing these stocks because I think they will beat estimates. I have no idea whether they will beat or miss. Nobody does. No matter what they tell you, I am sharing these stocks because they represent businesses so fundamentally strong that their value will compound over years regardless of what happens in any single quarter. This is a completely different approach to earnings season. Instead of gambling on short-term moves, you are positioning yourself to win over the long term. Instead of checking stock prices every hour, you can sleep soundly knowing that time is on your side. Let me start with a story that perfectly illustrates why most investors get earnings season wrong. Back in 1999, right before the dot-com bubble burst, I was invited to speak at a conference. The audience was full of technology investors who had made fortunes in the previous few years. They wanted to know my thoughts on various internet stocks, which ones would beat earnings, which ones should they buy before the next quarter. I told them I did not own any internet stocks. I told them I did not understand most of these businesses well enough to predict their futures. I told them that many of these companies had no profits, no clear path to profitability, and valuations that made no sense. They thought I was a dinosaur. They thought I had lost my touch. They laughed and went back to trading stocks that would soon lose 90% of their value. Now, I am not telling this story to say I was right and they were wrong. I missed plenty of great technology investments because I was too conservative. But the lesson is still valid. Trying to predict short-term results, trying to trade around earnings announcements is a losing game for almost everyone who plays it. The winners in investing are the people who find great businesses early and hold them through all the noise. So what makes a business worth owning through earnings season after earnings season, year after year, decade after decade? Let me tell you what I look for. First, I want a business with a genuine economic moat. This is a term I use to describe competitive advantages that protect a business from rivals. Just like a castle with a wide moat is protected from invaders, a business with economic moats is protected from competitors who want to steal its profits. Second, I want a business that generates substantial free cash flow. Cash is what allows a company to invest in growth, return capital to shareholders, and survive difficult times. Companies that burn cash instead of generating it are vulnerable to all sorts of problems. Third, I want a business with intelligent and honest management. Over the long term, you are essentially partnering with the people running the company. If they are not capable or not trustworthy, it does not matter how good the business looks on paper. Fourth, I want a business that benefits from long-term trends that are not going to reverse. I want the wind at my back, not in my face. When a business meets all four of these criteria, I can own it with confidence, regardless of what happens in any single quarter. Earnings might come in above expectations or below. The stock might jump or fall, but the underlying value of the business keeps compounding over time. Now let me tell you about the first stock I would buy before earnings season. American Express. This is a business I know intimately. I have owned it for decades. I first bought shares in 1964 during what was called the salad oil scandal. A fraudster had used American Express warehouse receipts as collateral for loans to buy vegetable oil. When the fraud was discovered, American Express faced massive liabilities. The stock collapsed. Everyone thought the company was finished. But I looked at the underlying business and saw something different. American Express had built a brand that consumers and merchants trusted. It had a network of cardholders and accepting merchants that was incredibly valuable. The scandal was a temporary problem. The brand and network were permanent assets. I bought heavily during that crisis, and that investment has returned many times my original purchase price over the decades since. Now, why would I recommend American Express before earnings season today? Because the fundamental strengths that made it a great investment in 1964 are even stronger today. American Express operates what I call a closed-loop network, unlike Visa and MasterCard, which simply process transactions between banks. American Express issues its own cards and acquires its own merchants. This gives them direct relationships on both sides of every transaction. They know exactly who is buying what, where, and how often. This data is incredibly valuable. American Express can use it to target offers to cardholders. They can help merchants understand their customers better. They can identify fraud more quickly because they see the complete picture of every transaction. But the real moat around American Express is the brand. Amex is associated with affluence, with success, with premium experiences. Cardholders are proud to pull out an American Express card. It signals something about who they are and what they have achieved. This brand positioning allows American Express to charge higher fees than competitors. Merchants pay more to accept Amex because Amex cardholders spend more. Cardholders pay annual fees that would be unthinkable for other cards because they value the prestige and the rewards. Think about what this means for earnings season. American Express does not need to report blowout numbers every quarter to be a good investment. The brand is not going to suddenly lose its appeal. The closed-loop network is not going to disappear. The data advantages are not going to evaporate. EI's quarterly spending volumes fluctuate based on economic conditions. Yes, credit losses vary as the economy expands and contracts, but the fundamental business, the competitive advantages that generate long-term value, those remain intact quarter after quarter. I look at my American Express position and I do not worry about what the next earnings report will show. I know that 10 years from now, 20 years from now, the brand will still be premium. The network will still be valuable. The data will still provide competitive advantages, and the business will be generating more cash than it does today. That is the kind of confidence you want when you own a stock through earnings season. Not hope that the numbers will be good. Certainty that the business will be valuable over the long term regardless of short-term fluctuations. The second stock I would buy before earnings season is Coca-Cola. I've been talking about Coca-Cola for so long that people probably think I am a broken record. But there is a reason I keep coming back to this business. It is one of the most perfect examples of durable competitive advantage that exists in the investment world. I first bought Coca-Cola stock in 1988. At the time, people told me I was paying too much. The stock traded at 15 times earnings, which was considered expensive for a beverage company. Analysts warned that the best days of cola were behind it. Health concerns were rising. Competition was intensifying. That was over 35 years ago. Since then, Coca-Cola has returned thousands of %, including dividends. The dividend alone now exceeds what I originally paid for my shares, and the business is stronger than ever. Why has Coca-Cola been such an extraordinary investment? Because it possesses what I consider the most powerful competitive advantage in business: an emotional connection with consumers that transcends logic. People do not drink Coca-Cola because it is the healthiest beverage. They do not drink it because it is the cheapest. They drink it because it makes them feel something. It reminds them of happy moments. It refreshes them on a hot day. It accompanies celebrations and everyday pleasures alike. This emotional connection has been built over more than a century of brilliant marketing. Coca-Cola is associated with happiness, with togetherness, with the simple pleasures of life. That association exists in the minds of billions of people around the world, and it is essentially impossible for competitors to replicate. You cannot create an emotional connection overnight. You cannot buy it. You cannot engineer it through clever product design. It takes decades of consistent brand building, and once you have it, it becomes a moat so wide that competitors cannot cross. Now think about what this means for earnings season. Coca-Cola might report that volumes were flat in North America. The stock might drop 3% on the news. Analysts might write reports questioning the company's growth prospects. But what has actually changed about the business? Nothing. The brand is still loved by billions of people. The distribution network, which reaches more corners of the world than any other consumer goods company, is still intact. The ability to generate enormous cash flows and return them to shareholders is still there. This is what I mean by owning businesses that do not depend on quarterly results. Coca-Cola's value does not come from whether it sells slightly more or fewer cases of soda in any given quarter. Its value comes from an emotional connection with consumers that has been built over a century and will persist for another century. I sleep well at night owning Coca-Cola because I know that 50 years from now people will still be drinking Coke. They will still associate it with happiness. They will still pay a premium for the brand over generic alternatives. And the company will still be generating cash and returning it to shareholders. When you own a business like this, earnings season is not something to fear. It is just another data point in a very long story. Sometimes the data point is positive, sometimes it is negative, but the story keeps moving in the same direction over decades. The third stock I would buy before earnings season is Bank of America. Now I can already hear some of you protesting. Banks are cyclical. They are sensitive to interest rates. They face regulatory risk. How can a bank be a good stock to own through earnings season? Let me explain why I think Bank of America is different from most banks and why it belongs in a portfolio designed for long-term wealth creation first. Some context. I made a significant investment in Bank of America during the financial crisis of 2008 and 2009. The banking system was in chaos. Major institutions were failing. People thought the entire financial system might collapse. I saw an opportunity. Bank of America had problems, serious problems, but it also had something incredibly valuable. A deposit base of over $1 trillion from millions of customers who used the bank for their everyday financial needs. Those deposits represent a low-cost source of funding that is extremely difficult for competitors to replicate. When you have checking accounts and savings accounts from millions of ordinary Americans, you have access to capital at rates that other financial institutions cannot match. This funding advantage translates directly into higher profitability over time. Think about what it would take to compete with Bank of America's deposit base. You would need to build thousands of branches. You would need to invest billions in technology. You would need to convince millions of people to move their banking relationships. This takes decades. It costs enormous amounts of money. And even then, you might not succeed because people are remarkably sticky with their banking relationships. The average American keeps their primary checking account for 15 to 20 years. Once someone chooses a bank, they rarely switch. The hassle of changing direct deposits, automatic payments, and all the other connections is simply too great. This creates enormous customer lifetime value and provides a stable base of funding that persists through economic cycles. Now, does Bank of America's stock fluctuate based on quarterly results? Absolutely. Interest rate changes impact net interest margins. Credit losses rise during recessions. Regulatory changes affect profitability. The stock can move 10 or 15% in a quarter based on these factors. But here's what does not change: the deposit base, the customer relationships, the scale advantages that come from being one of the largest banks in the country. These competitive advantages persist through cycles, and over the long term, they drive consistent value creation. Let me give you a specific example during the pandemic in 2020. Bank of America's stock fell dramatically. Investors worried about loan losses. They worried about low interest rates squeezing margins. They worried about economic collapse. But what actually happened? The deposit base grew. Customers actually increased their savings during the pandemic. They deposited stimulus checks. They reduced spending and accumulated cash. Bank of America ended up with even more low-cost funding than before. This is what I mean by focusing on competitive advantages rather than quarterly results. Yes, the earnings report in any given quarter might be disappointing, but the structural advantages that drive long-term value are still intact. Today, Bank of America generates over $30 billion in annual profit. It returns a significant portion of this to shareholders through dividends and buybacks. It has the scale and technology infrastructure to compete effectively in digital banking, and it has a management team that has consistently improved the company's efficiency and risk management over the past decade. When I think about owning Bank of America through earnings season, I am not worried about whether net interest margins came in above or below estimates. I am thinking about the fact that 100 million Americans trust this institution with their money. That is an asset that cannot be replicated quickly and cannot be destroyed by one bad quarter. No, let me pull back and explain the common thread connecting these three stocks: American Express, Coca-Cola, Bank of America. All three of these businesses have competitive advantages that are measured in decades, not quarters. The American Express brand has been built over more than a century. The Coca-Cola emotional connection spans generations. Bank of America's deposit relationships have been established over lifetimes. These are not advantages that can be disrupted by a new startup with a clever app. They are not advantages that evaporate when the economy slows down. They are structural features of these businesses that persist through all manner of short-term volatility. This is exactly what you want in a stock you plan to hold through earnings season. You want advantages so durable that no single quarterly report can meaningfully impact them. You want businesses so fundamentally strong that short-term fluctuations are just noise in a longer signal. Think about the alternative. Imagine owning a stock whose competitive position depends on having the latest technology or the lowest price. Every quarter, you would worry about whether competitors have caught up. Every earnings report would be a judgment on whether the company is still winning in the marketplace. That kind of uncertainty is exhausting. It leads to constant second guessing. It tempts you to make trades based on short-term news rather than long-term value, and it often results in selling good businesses at exactly the wrong time. When you own businesses with truly durable competitive advantages, you can approach earnings season with equanimity. The quarterly numbers are interesting as data points. They help you understand how the business is performing, but they do not change your fundamental thesis because your thesis is based on advantages that persist across quarters and across years. Let me share another observation from decades of investing. The best time to buy stocks is often when everyone else is worried about earnings, when uncertainty is high, when analysts are warning of potential disappointment, when investors are selling in anticipation of bad news. This seems counterintuitive. Why would you want to buy when risks seem elevated? Because the market often overreacts to uncertainty. Stocks get marked down not just for the expected bad news, but for all the potential bad news that might not even happen. And when the actual results come in, even if they are disappointing, they are often not as bad as feared. I have made some of my best investments by buying during periods of maximum uncertainty. The salad oil scandal with American Express, the financial crisis with Bank of America, Countless other situations where short-term fears created long-term opportunities. But you can only take advantage of these opportunities if you understand the businesses you are buying. If you know that the competitive advantages are intact, even when quarterly results are weak. If you have the conviction to buy when others are selling and hold when others are panicking. This brings me back to my central point about earnings season. The goal is not to avoid volatility. Volatility is unavoidable if you own stocks. The goal is to position yourself so that volatility works in your favor over time. When you own exceptional businesses at reasonable prices, volatility becomes your friend. Short-term declines let you buy more at better prices. Short-term surges let you enjoy paper gains while you wait for the business to compound. Either way, time is on your side. But when you own mediocre businesses or when you pay too much for good businesses, volatility becomes your enemy. Short-term declines feel like permanent losses because you are not confident in the underlying value. Short-term surges tempt you to sell because you are not sure the business will keep performing. The three stocks I have shared today, American Express, Coca-Cola, and Bank of America, are businesses I can own with complete conviction. I do not need to know what their next earnings report will say. I do not need to predict whether they will beat or miss estimates. I simply need to know that their competitive advantages are intact and that their long-term trajectories are positive. That is the test I encourage you to apply to your own portfolio. For each stock you own, ask yourself this question. Would I be comfortable holding this through a disappointing earnings report? If the answer is no, if you would be tempted to sell on bad news, that tells you something important. Either you do not understand the business well enough, or the business does not have the durable advantages needed for long-term investment. The investors who build real wealth are not the ones who make the best trades around earnings. They are the ones who own the right businesses and hold them through thick and thin. They are the ones who view earnings season as noise rather than signal. They are the ones who measure their success in decades rather than quarters. I have been doing this for over 70 years. I have seen bull markets and bear markets. I have seen recessions and recoveries. I have seen stocks surge and crash. And through it all, the same principle has held true. Owning exceptional businesses and holding them for the long-term beats, trying to trade around short-term events. This earnings season, instead of watching stock prices tick by tick, instead of analyzing every line item in every earnings report, instead of reading every analyst's opinion on every stock you own, try something different. Step back. Ask yourself whether the businesses you own have durable competitive advantages. Ask yourself whether you would be comfortable owning them for 10 years, regardless of quarterly fluctuations. If the answer is yes, then earnings season should not worry you. The quarterly results will be what they will be. The stock prices will move in whatever direction they move, but you will know that time is on your side. You will know that the businesses you own are compounding value for you, regardless of short-term noise. And if the answer is no, if you are not comfortable holding through uncertainty, then perhaps earnings season is an opportunity to reassess. Perhaps it is time to sell the businesses you do not understand and buy the ones you do. Perhaps it is time to shift from a trading mentality to an ownership mentality. This shift in perspective is one of the most valuable things I can offer. It took me years to fully embrace it myself. Early in my career, I was more focused on finding cheap stocks than on finding great businesses. I traded more frequently. I paid more attention to short-term factors. But over time, I learned that the best returns come from owning exceptional businesses for long periods. The compounding effect is extraordinary. A great business that grows at 15% per year will be worth 4 times more in 10 years. Let it compound for 20 years and it is worth 16 times more. Let it compound for 30 years and it is worth 66 times more. This is the magic of long-term investing. And it only works if you can hold through the volatility, through the disappointing quarters, through the earnings seasons that make everyone else nervous. The 3 stocks I have shared today are businesses built for this kind of long-term ownership. American Express with its premium brand and closed-loop network, Coca-Cola with its emotional connection to billions of consumers, Bank of America, with its massive deposit base and scale advantages, own these businesses, hold them through earnings season after earnings season. Do not panic when short-term results disappoint. Do not celebrate excessively when they exceed expectations. Just keep owning great businesses and let time do its work. That is the approach that has served me well for over 7 decades. That is the approach that will serve you well for decades to come. The quarterly noise will always be there. The market will always overreact in both directions. But the patient owners of exceptional businesses will always come out ahead in the end. Focus on quality, think long term. Let compounding work its magic. Everything else is just distraction. Now I want to address something that I know many of you are thinking about. You are wondering about the specific mechanics of how these businesses will perform in the current environment. Interest rates are elevated. Inflation has been persistent. Consumer sentiment fluctuates month to month. How can I be so confident about these 3 stocks when the economic backdrop is so uncertain? This is exactly the wrong question to be asking, and the fact that so many investors ask it explains why so many investors fail. Let me explain what I mean. When you focus on the current economic environment, you are implicitly assuming that you can predict how it will change. You are assuming that you know whether interest rates will rise or fall. You are assuming that you know whether consumers will keep spending or pull back. You are assuming that you know what the economy will look like in 6 months or 12 months. But nobody knows these things. Not the Federal Reserve, not the smartest economists at the best universities, not the most experienced investors on Wall Street. Economic forecasting is notoriously unreliable. Anyone who tells you they know what the economy will do next is either lying or deluded. So instead of trying to predict the economic environment, I focus on businesses that will perform reasonably well across a wide range of environments. Businesses that do not need everything to go right to succeed. Businesses that can weather recessions and still come out stronger on the other side. All 3 stocks I mentioned today fit this description. American Express has been through multiple recessions. Yes, credit losses rise during downturns. Yes, consumer spending declines temporarily, but the brand survives, the network survives. And when the economy recovers, as it always does, the business emerges stronger because weaker competitors have been eliminated. Coca-Cola has been through world wars, depressions, recessions, and every other kind of economic turmoil you can imagine. People still drink Coke during hard times. They might trade down from restaurants to drinking at home. They might buy smaller sizes, but they keep buying. The product provides an affordable moment of pleasure that people are reluctant to give up even when budgets are tight. Bank of America has weathered multiple financial crises. Yes, the stock got decimated in 2008, but the business survived. It emerged stronger. It cleaned up its balance sheet, improved its operations, and built capabilities that made it more competitive than before. The customers who trusted the bank with their deposits during the crisis are still customers today. This is resilience. This is what you want in a business you plan to own through uncertain times. Not a business that needs a perfect environment to succeed. A business that can take a punch and keep moving forward. Let me tell you about a mental exercise I use when evaluating investments. I ask myself, what would happen if we had a severe recession tomorrow? Not a mild slowdown, a real recession with rising unemployment and falling consumer spending. For American Express, I know that spending volumes would decline. Credit losses would increase. Profits would fall, perhaps significantly. The stock would probably drop 30 or 40%. But would the business be permanently impaired? Would the brand lose its premium status? Would the closed-loop network become worthless? Of course not. The company would tighten its belt, work through the difficult period, and emerge on the other side with its competitive advantages intact. For Coca-Cola, I know that out-of-home consumption would decline as people ate at restaurants less frequently. Convenience store sales might soften as discretionary spending tightened. But would people stop drinking Coca-Cola entirely? Would the brand suddenly lose its emotional connection with consumers? Would the distribution network, which took a century to build, suddenly become worthless? Absolutely not. For Bank of America, I know that loan losses would spike. Net interest margins might compress. The stock would probably get cut in half. But would the deposit base disappear? Would customers suddenly close their checking accounts and move to a competitor? Would the fundamental business model of taking in deposits and making loans become obsolete? The bank would increase its loan loss reserves, work through the problem loans, and eventually return to normal profitability. This is the kind of analysis that gives me confidence through earnings season and through economic uncertainty. I am not trying to predict what will happen. I am trying to own businesses that will survive and ultimately thrive regardless of what happens. Now let me talk about something else that concerns many investors during earnings season, the role of analysts and their expectations. Every quarter, Wall Street analysts publish estimates for what they think companies will earn. When actual results come in above these estimates, stocks typically rise. When results come in below estimates, stocks typically fall. Many investors treat these reactions as signals about business quality. They assume that beating estimates means the business is doing well and missing estimates means it is doing poorly. This is a profound misunderstanding of how the game works. Analyst estimates are not measures of business quality. They are measures of expectations management. Let me explain. Companies spend enormous amounts of time and energy managing analyst expectations. They provide guidance that shapes what analysts expect. They time announcements and transactions to hit or exceed quarterly targets. They have entire departments dedicated to investor relations, which is essentially the art of making sure expectations are set appropriately. So when a company beats estimates, it might mean the business is performing exceptionally well, or it might mean the company successfully managed expectations to be low enough that they could exceed them. Conversely, when a company misses estimates, it might mean the business is struggling, or it might mean something unusual happened that quarter that the company did not adequately communicate to analysts. I do not play this game. I do not care whether a company beats or misses analyst estimates. I care whether the underlying business is performing in line with my own assessment of its potential. If I believe a business should be able to grow profits at 8% per year over the long term, I do not care whether they grew at 10% this quarter or 6%. I care whether the long-term trajectory is intact. This perspective frees you from the tyranny of quarterly expectations. You no longer need to check stock prices. The second earnings are announced, you no longer need to parse every word of the earnings call to figure out what management is signaling. You simply assess whether the business is on track with its long-term potential and make decisions accordingly. For the three stocks I mentioned today, I have very clear long-term expectations. American Express should be able to grow revenues in the high single digits and earnings somewhat faster due to operating leverage. Cola should be able to grow revenues in the mid-single digits and return substantial capital to shareholders through dividends and buybacks. Bank of America should be able to generate returns on equity in the low double digits and return most of its earnings to shareholders. These are long-term expectations measured over 5- and 10-year periods. In any given quarter, actual results might be higher or lower. The stock might react positively or negatively. But as long as the long-term trajectory remains intact, I am happy to hold through the volatility. I want to share one more insight about earnings season that most investors never consider. The companies that make the best long-term investments are often not the ones that generate the most excitement during earnings season. Think about it. What kind of company generates excitement during earnings season? Typically, it is a company with highly variable results. A company that might beat estimates by 50% or miss by 50%. A company whose business is so unpredictable that every quarterly report is a genuine surprise. These companies make for exciting trading. Speculators love them because the potential swings are enormous. Financial media loves them because dramatic moves generate clicks and viewership. But they make terrible long-term investments because the unpredictability that creates excitement also creates risk. The best long-term investments are boring during earnings season. American Express reports another quarter of steady growth. Coca-Cola reports another quarter of modest revenue increase and consistent margins. Bank of America reports another quarter of solid profitability. The stocks move a few percent in either direction. Nobody writes breathless articles about the results. And the businesses keep compounding value for their owners. I will take boring over exciting any day when it comes to my investment portfolio. Boring means predictable. Predictable means I can make reasonable estimates of future value. Reasonable estimates mean I can make rational investment decisions rather than gambling on outcomes. I cannot foresee. This is perhaps the most important lesson I can share about investing before earnings season. Do not try to find stocks that will make exciting moves on their quarterly reports. Try to find businesses so consistent, so predictable, so fundamentally sound that their quarterly reports barely matter. Own those businesses for the long term. Let the excitement seekers chase volatility. You will be building wealth while they are churning their portfolios and paying taxes and commissions. The three stocks I have shared today, American Express, Coca-Cola, and Bank of America, are not exciting stocks. They are not going to double on an earnings beat. They are not going to generate breathless headlines about revolutionary new products. They are just going to keep doing what they have been doing for decades. Building brands, strengthening relationships, generating cash, returning capital to shareholders, compounding value year after year. That is exactly what I want in my portfolio. And it is exactly what you should want in yours. As we approach the next earnings season, I encourage you to step back from the noise, ignore the previews and predictions, ignore the analyst upgrades and downgrades. Ignore the speculation about whether this company or that company will beat or miss. Instead, focus on the only question that really matters. Do I own businesses with durable competitive advantages that will be more valuable over time? If the answer is yes, then earnings season is nothing to worry about. If the answer is no, then use this as an opportunity to improve your portfolio. The path to wealth in the stock market is not paved with clever trades and perfect timing. It is paved with ownership of exceptional businesses held through all manner of short-term volatility. That is the approach that has worked for me for over 70 years. And that is the approach that will work for you if you have the discipline and patience to follow it. Own quality. Ignore noise. Let time do its work. That is the secret to investing before earnings season, and the secret to investing in general. There is no more reliable path to building lasting wealth.